Yes. Hello, this is Terry Lavery with Remax Commercial, starting a webinar here on banking with a number of panelists that we have here. We have Reed Clark from Great Western Bank. We also have Mike Wall from Pacific Premier Bank and Dave Lyons from National Bank of Arizona. Again, I'm your moderator. And anyways, we want to get Reed started off. And Reed, go ahead. If you could visit a little bit about your bank and what division you're in, and kind of let us know what's going on here as far as 2020 and all the interesting things going on in banking.
Yeah, a few interesting things for sure. Thanks, Terry. I'm Reed Clark with Great Western Bank. And we're a commercial bank based in Sioux Falls, South Dakota. Been in Tucson a long time. And about 14 billion in size, publicly traded, capable of doing deals to any extent needed as far as size goes, but still we don't shy away from sort of a typical Tucson transaction, which would be a little bit smaller size. And what's kind of nice is that the bank is one of the top agricultural lending banks in the country, and that frees up a whole bunch of real estate. So we're not concentrated on real estate, and so we can look at property types that some other folks maybe have enough of, and that's been it's been successful for us. The past few months have been interesting for all of the panelists and all the other bankers in town for sure. A lot of things thrown at us in a quick way, and hopefully everybody got their PPP loans successfully transacted after kind of a rocky start. So we did as many as we could. We did about 800 million, about 4,600 of those loans nationwide, and those were something that I think is real important, and we can talk a little bit about that as soon as we get kind of along those lines. So Terry, with that, you can sort of point me in the right direction as to what you'd like me to touch on, if anything, and we can certainly go from there.
Sure. You've been, I'm sure, pitched a lot by a lot of your clients as far as loan relief's concerned. What would you say is the percentage of people looking for, some type of modification as far as the bank's concerned with today's environment?
I would say probably a third, probably 30% or so were after some sort of relief. Not all needed it. Most took it. The banks overall, they to my understanding, gave it relatively willfully, as they should, in a circumstance as dire as this. We're in a spot where global cash flow for the first time probably in 80 years stopped around the world. So as a result of that, it's dire circumstances, and so it needs to be met with some dire solutions. And hopefully that was the case across the board with respect to the payment deferrals, is what I'm assuming you were talking about there, Terry.
Right. Yeah, and I guess I would like to know if you have some guidance for lenders or people going in to ask for modifications that bankers are looking for right now as far as just dealing with the situation. And guess I'm trying to get more towards documentation of forbearance there.
Well, as far as documentation forbearance, they're done on a case-by-case basis. And so what I'd probably touch on, the deferrals that were done initially are fully completed now. And I think that that the question is, what's that second quarter, or the third quarter in this case, what's the next 3-month period going to look like? And I think banks are going to consider deferrals on a case-by-case basis, and they're going to have to probably be a little more selective than they were, so as not to kick the can down the road. A second round of deferrals is certainly possible. They may be a little different. They may indicate or include maybe principal deferrals only or something of that nature. If there's a second deferral that's needed, the question, of course, is it a problem that's not temporary? And that's going to be kind of the question, and it's going to depend on industry. Certainly, hotels, for example, are going to need it. Extended stay hotels, are coming back a bit. They're faring okay. Other local hotels, they can largely shut down or scale down for the summer as they would do seasonally anyway. And then resort hotels, of course, are going to probably be impacted a lot longer. So anybody that's in a unique circumstance, event venues, sporting, things like that are going to need additional help. And we don't know what that guidance is. So long story short is the Fed did not require the banks take any negative action or downgrades for the first 90-day deferrals for folks who needed it. We don't have guidance, to my knowledge, on the second round yet. So if there is any, we don't know what the Fed is going to let us do or not let us do.
Yeah, I was kind of looking at some of our subcategories that we report as far as our annual forecasts, and I know just kind of sub markets that are hurting right now, as you said, the hotel, definitely office, and also retail. And then I've even seen some analysts talking about just commercial real estate in general, as far as, you know, difficult times looking forward. And I'm sure it's because of turnover and lower rent and collection issues and modifications and uncertainty and capital expenditures, all those things that are kind of affecting everybody's bottom line and pocketbook. Could you maybe visit a little bit? I think we talked about this on the phone before we had this webinar, but has to do with, you know, credit versus cash flow. I know there's a lot of people that can go and borrow a lot of money, but if their business model isn't getting better, or their you know, their cash flow is starting to really you know, take a hit, you know, you have to look differently at what's going on.
Yeah, it's always an interesting question, credit versus cash flow. You know, you really need both, but cash flow is what repays loans. So to your point, cash flow is obviously looked at. Everybody's cash flow has been negatively impacted. To what degree is the question. Projections become increasingly more important, but also increasingly less reliable, because everybody's giving best guesses, and some want to feed, you know, good news where there maybe isn't, and those are difficult circumstances, certainly. But I think that most of the banks are going to take a look at what we call secondary repayment sources, and that would be collateral quality and sponsorship. So those things, I think, have to be there going forward. You know, with respect to new credit going forward, I don't think any of the banks are or have changed direction to any significant degree with respect to lending. It's just a matter that that there just needs to be more care put into it, and the borrowers are going to have to you know, just provide some additional information with respect to you know, repayment in their cash flow situation. And it would be probably in addition to what they've already accustomed to doing, but nonetheless, it would be something that would certainly get their credit done, you know, versus having them have some problems.
Are you seeing many people come in just on their own, or are they coming in with you know, another like a real estate broker or a lawyer? I mean, just to handle renegotiations going on, or is that just something that you are all doing as far as you know, responsibility of being the lender?
You know, it'll be interesting to hear Mike and Dave's view on that as well. We're seeing individual. We're not. None of the banks that I know are renegotiating things. The payment deferral was a timeout. It was a very necessary one, and as a result, it gave everybody a chance to kind of assess what's going to go on. And even though there's a lot of uncertainty out there, I think that there's still more ability to predict how things are going with respect to some consumer behaviors and whatnot that we could certainly get into. But nonetheless, I think that it's largely been individual requests for deferrals and not for renegotiations, because that point, in at least in our portfolio world, has not come.
Yeah, I was just wondering about, you know, the difference as far as, you know, big borrowers versus mom and pa's, and, you know, just kind of the sophistication, especially with the complexity of what's going on as far as, you know, the necessary documentation. It just seems like it's a new beginning for a lot of people as far as, you know, at least being able to move forward, especially with, if they've already done budgets for 2020 and, they look great in the first quarter and went to hell in a handbasket in the second quarter. And now they're into reconstruction. And, I guess you have to start looking at, who's going to be around in 2021. And, if it is what it is and it's a tough situation and they got a rental property and no one's paying rent, it's, sounds like a workout to me. Don't you think?
Yeah, I mean, the banks are all, since the end of first quarter, even at the end of March, you could see the banks had decided at the last minute to start reserving a lot for losses, and we know losses are coming. It's inevitable at this point, but the question is how far and how deep. And to that, I don't think we know. Seasoned properties and folks in the class, even the class C and D property world, largely own their properties free and clear or just about. So they're able to absorb a lot, and that makes a difference. Folks who are more heavily leveraged on the upside, being on newer projects, there's still some dents in some newer projects, but those can typically be ironed out. To your point with respect to documentation, the mom and pops typically have standard bank documentation that's a lot easier to change. The more sophisticated loans require attorneys to do that. It takes more time and there's a bit of a cost to do that. So the folks that have, smaller loans that needed some relief right away, got it, 2.5 weeks kind of before everybody else did, just from a logistical standpoint, because the attorneys were busy modifying some documents. So.
Great. Well, Reed, thank you. Tiffany, can you, do you have any questions? Anyone raised their hand so far, I guess, as far as the attendees?
Not yet.
Not yet. Okay. Well, then we'll move on. Thank you again, Reed. Mike Wall.
Hey, good afternoon. Appreciate the opportunity to speak. I was telling Reed earlier, some of us don't like to wear pants anymore, Shay, so forgive me, my face is not on here today. But
that's why I'm sitting down.
So I'll tell you a little bit about the bank. I don't know if some of you may not know, Grand Point Bank, which was Bank of Tucson, was acquired a couple of years ago here in Tucson and by Pacific Premier Bank. We were $12 billion in assets after that acquisition. We actually announced an acquisition of Opus Bank out of California in January and finalized the acquisition, believe it or not, June 1st amongst all this stuff. So, and that was an $8 billion acquisition. So we're now $20 billion in assets, publicly traded. We still operate as a regional bank. We're basically increasing our footprint. We have locations in Arizona, Nevada, California, Oregon, and Washington. So acquisition of Opus Bank gave us a lot of locations in Oregon and Washington, as well as the Bay Area, San Francisco. In terms of what our offerings, I mean, we're very, very diverse. We have a franchise finance group that finances franchises nationwide. We have a HOA group based out of Dallas that both handles HOA banking and HOA lending for those pretty much unsecured loans to homeowners associations. So we've got an SBA group. I mean, we're very diverse in our offerings. The Opus Bank acquisition actually gave us a lot of good real estate loans. They had a great portfolio, as well as trust services now. So we do have a trust services department. So I manage a team of relationship managers here in Tucson. When we work with small to mid-sized businesses, we have some middle market size clients, and we also have a lot of mom and pop clients. So I do have a short PowerPoint. I won't bore you to death. I'll try to share my screen. I've never done this before, but give me 1 second.
Hey, Mike. While you're doing that, I just had a quick question.
Sure.
As far as your clients at the bank, do you really feel like they have a understanding of the problem that they're in at this point, or is there just a lot of people with their heads still in the sand and hoping everything turns out okay?
Well, I mean, I think it kind of runs the gamut because, you do have some unsophisticated business owners and borrowers, some mom and pop folks that, talk about the PPP loan process. Had a couple folks that the challenge was getting the right documentation. And there were some folks that, took a couple weeks to get me their documents, and, they wanted to fax things and so on and so forth. So, they just, you know, it runs the gamut in terms of mom and pop that aren't so sophisticated, and they're not, you know, they don't have current financials. They don't, you know, they don't stay up to date. And I think those folks are probably at more of a risk of not surviving the pandemic. But we also have some really sophisticated clients and larger middle market clients that have a lot of resources. They have a CFO. They're always in tune with their financials and what have you. And I think those people are more, they're more well positioned for success going forward. So,
Yeah, you were going to go over a little bit, I think, as far as today's credit requirements and how that's changed from the first of the year.
yeah, can everyone see that presentation or no?
Yeah, I got it. Go ahead, Mike.
Okay. Let me see if I can skip here. Yeah, I just want to cover a few things: credit appetite and underwriting, and we already touched on payment deferment. So I second a lot of the stuff that Reed already mentioned, but I'll share a few thoughts. And in terms of, you know, helping prepare your clients to for success and trying to get a loan approved in this day and age, I will say that I think all of us are, you know, as bankers and banks are very conservative in terms of approving loans right now because there's a lot of uncertainty. We don't know about what kind of fallout there's going to be going forward. You know, a lot of these businesses that are struggling, you know, it may take them 12 months to, you know, to fail or longer, 12 to 18 months. So we really have to dig in. You know, similar to after 2008, we were trying to figure out, okay, is there a light at the end of the tunnel? Did the business turn the corner? But unfortunately, this situation is not the same in terms of being able to assess whether or not there's a light at the end of the tunnel because there's still a lot of uncertainty. So I would just say, you know, for a borrower, you know, looking at year-over-year interim financials, so year-to-date, say through, for example, through May, look at it from this year and then the prior year for the same period is going to help us kind of take a look and see how the company's performing. Income statements broken out by month. That's going to be helpful in terms of looking at, you know, post March 15th to March 31st. We're actually requesting projections, and that's where I think to that point about sophistication is, you know, if you're looking to get a loan, we want to see, you know, what you're projecting and what assumptions are tied to those projections. And then the last thing I put here is quality financial statements. So, you know, when looking at, it's great if you have a reviewed statement from your CPA for last year, but also in-house financial statements that, you know, don't have a bunch of negative entries or the balance sheet doesn't balance, you know, that's a problem. So those are all important. In terms of qualities, you know, strong management and thinking about post 2008, you know, has the business owner been through a downturn before and how they handle it? Did they make the right cuts? I think that the management piece is one of the biggest things that's telling in this environment is whether or not, you know, in terms of repayment. So strong debt service coverage, sufficient liquidity and secondary source of repayment. So not only having cash flow from the business, but maybe outside income and or liquidity cash. And then what we're looking at today is, okay, how much has your business been impacted from the pandemic? And if it's minor or, you know, it's maybe a supply chain issue, not so much a, you know, profitability or revenue issue, then it's going to make it a lot easier to justify approving a credit. And also for, say, for investment property reserves for monthly payments and so on. So.
Mike, one thing I guess I didn't see right there is like loan to value ratios. I mean, I know if you're talking about a residential house in Tucson right now, it's one of those safe investments, and you know, you can look at the mortgage on it and see they may have some equity. It's just a question of how much. And you know, are those strong considerations, I guess, as far as restructurings are concerned?
Yeah, I mean, we loan to value is important, and I would say for us, I mean, we're taking a more conservative approach. So like investor real estate, I mean, we're probably looking at max 60% right now in this environment in the interim. So I mean, it's important, but you know, even if you have a low loan to value, say 30%, it's not going to guarantee we get repaid. So I think you got to dig in on why is this person wanting to invest in this environment? Why are they wanting to add additional leverage? Does it make sense? Those are all considerations for us approving a loan. So LTV, I would say, is important, but it's not going to be the key driver behind approving a credit for the bank. So
just one of the tests, I guess, that's going on.
Correct.
Yeah, I was in a kind of a meeting this morning, and they had a deal that was on the table, and the bank didn't approve it, and the guy was going, what's our next step? And I was asking him about owner financing and him becoming the bank. Are you seeing a lot of that? I mean, as far as owners of property having to become more creative if in fact they are forced into a liquidity situation or a restructuring?
I don't know. I haven't seen a ton of it, and I think in my experience in this environment, the demand has been down. I mean, we're getting a lot of requests. We're getting some requests for like cash out refinances on investor real estate and so on, and those are ones that kind of drive concern as to why they want to be cash out. What are they bleeding in other areas, other businesses that they own or other properties, and so. That's what that is, to be honest, that's I think I've seen the most demand in cash out refinances, and it begs the question is why do they want to do cash out, and does it make sense? And so that's what I'm seeing mostly.
Okay, I'm sorry to interrupt you on your presentation. Go ahead.
You're fine. I was just going to say in terms of the payment deferment, Reed was right on for us anyway, that it's on a case-by-case basis. Most of that, the first round, 90 days is up. What I did, what we saw a lot of is borrowers that were opportunistic. You have a borrower that has, they want a payment deferment for 90 days, and they have, say $3 million in cash in the bank, and so those are those situations where we've had some clients that are saying, well, this is unprecedented time, so on and so forth. But we have to ask both on the investor side and the operating business side, what has the business owner done to help themselves in terms of cuts or margins or whatnot, and are they willing to step up and put their own excess cash in? So there's been some that we haven't approved based on the fact that they have access to liquidity, and it wasn't we as the bank said, hey, recessions do happen. I mean, given this is a really weird one, but you kind of have to be prepared, for a rainy day if you're a business owner. So we haven't approved all the ones that came across the table. And you talked about borrowers that are really struggling. Some of these are the obvious: restaurants, hospitality, retail, not big box, because that seems to be gangbusters, right, with the pandemic. Investor real estate, we have I've had some investors that their tenants are requesting relief, and commercial properties, and basically they're giving them a deferment, but it's more so they're going to spread that lease, the missing lease payments in the term of the lease, so that they can make up for it, because rather than tacking it at the end of the lease, because they want to make sure they get their return. So we're seeing that, and then that's kind of where a lot of the investors are coming to us saying, hey, my tenants aren't paying, or they want relief. What can you do to kind of offset that on the bank side?
So is it safe to say if I came in with an affordable housing deal or a residential situation or a single tenant, they'd probably be looked at as more safe than the ones you just listed?
Yeah, we say single tenant. Single tenant obviously is a risk. I think we're seeing is I have been, we do a lot of different loans and lines of credit. There's still that single family residence, the pool of properties that we're willing to lend on, that if it that seems to, from what I'm seeing, seems to be the most reliable right now in terms of repayment. So I would say single tenant. It depends on the tenant. If it's a national tenant and they're doing well, then it's a consideration. But otherwise, I think multifamily and we have a diversity in the tenant base. I think that's really a benefit. It's a lower risk than looking at some of the single tenant or strip center. So.
Well, last question, and then we'll let you rest for a little bit. As far as the appraisal process is concerned, I guess if you're using the income approach, it's got to have some caveats in there as far as what they were in 2019 versus where they are half a year into 2020, and where they're going into the future. But sure. Are you relying more on how much cost is in as far as value is concerned, or market, as opposed to income? I guess just in you coming up with values in order to make credit decisions.
Yeah, that's a tough question. I I guess I haven't seen a, I haven't been able to, haven't had enough time to compare, an appraisal from, say February or March to today. So I would, and maybe you guys can speak to that. I would assume there's definitely some correction in certain sectors and what have you. But I think it's for me, it's been too soon to figure that out. So, but I'm sure some of you real estate guys out there would probably have a better feel for
that. Sorry to put you on the spot.
No, you're fine. You're
fine. Tiffany, any questions for Mike?
Yeah, it looks like from Joe Snap. He has a few questions. So the first one is, how many new CRE income producing deals can you be originating if you are limited to LTV or 60% question? We are not doing that. Other banks are not doing that either. For all income producing deals. Wow.
Okay, so I'm sorry, was that a question?
Well, I think the first part was, how many new CRE income producing deals can you be originating if you are limiting LTV to 60%?
Well, not very many. I mean, you have we just expect we want low leverage deals in this environment and people to come to the table with cash. So, for an experienced investor that has liquidity, has reserves. I mean, that adage that they say that, banks will give you a loan when you don't need it. I mean, it's kind of, we're in this environment, there's so much uncertainty that, yeah, we're going to be conservative. And maybe Dave and Reed, you can talk to that a little bit more. But I think for us, we're trying to be responsible in terms of shareholders, also in terms of our clients, because, you step out and with this uncertainty and start making loans, and be real aggressive, and it's a risk to the bank and it's a risk to the customers in the long run, because when if we're not in a good position financially in the long term, then we're you got clients that bank with us that are bad things happen in terms of the loan portfolio and so on.
Tiffany, was there one more question?
Yeah, well, it's kind of like and then he says 90-day payment deferral ? Nobody is offering a longer period. So is there anybody, I guess, out there offering longer periods?
I would say, and Reed and David can talk about that. For us, I mean, it is on a case-by-case basis. I don't think I've seen any come across my desk that are longer than 90 days. So I'm sure certain situations, I mean, we may be running into another situation here where the 98 days is up and we have to look at it again. But at this point, I haven't seen any longer than 90 come across my desk. So Reed and David, I don't know what your thoughts are.
Same here. We haven't done any more than 90 days. We haven't had any requests longer than 90 days. So.
Yeah. Well, good segue into Dave Lyons with National Bank of Arizona. Dave, how you doing?
I'm good, Terry. Thanks. Good afternoon, everybody. At lunchtime, and everybody's getting sick of hearing of bankers. So.
They're getting indigestion at this point.
Exactly. Yeah. No, so I'm Dave Lyons, been with National Bank a little over 25 years, born and raised here. National Bank is part of Zions Bank out of Salt Lake City, Utah, publicly traded in the 11 Western states. So we have really good coverage throughout the entire Western United States. Touching a little on PPP loans, because that kind of leads into where I want to go. The bank was really, really active at really trying to help the communities in which we bank with the PPP loans. So we ended up doing in Arizona, Zions Bank ended up doing 44,000 loans for a little over $7 billion. In Arizona, we did just shy of 6,000 loans for $760 million. So very, very active. It was a tough period of time because, everybody had their regular day job and, needed to answer phone calls, needed to operate the branches. But then this tremendous volume of deals that came in, the customers that really needed the money were a very high stress level. The program was not clearly defined when it first rolled out. There were 2 rounds, money ran out. It was an incredibly stressful time for everybody, and kind of glad to have that winding down. It ends the end of this month. We're still seeing applications. There were, so far in the last 3 days, we've had 45 applications. So, people are still coming in looking for money. I don't know where they've been, but maybe they've just now figured out that they're able to get it. But in all that, volume, we did about 1/3 of all the deals we did were for non-bank customers. So we had a little extra due diligence because we, we're not aware of who the clients were. We needed to check them out. But I think the bank's philosophy of trying to help everybody and not just their own clients and customers really set us up fairly well for now onboarding a huge volume of new clients. And, thankfully they're pretty dissatisfied with the bank where they are right now and ready to move the entire relationship. So, from the owner occupied C&I world, we're doing a lot of business moving customers over, and some of them, their cash flow is not pristine. It's been affected. So having to do a little deeper dive. I think Reed and Mike both talked on cash flow is really the important driver in what repays loans. Collateral is great, but when you go and get into a deal and you're relying on collateral, you're also relying on somebody else that likes that collateral more than you do. So it's a hard way to say we're making loans at X amount of loan to value, because it really it's probably not the right way to look at things. Everything is cash flow driven, but we are moving a lot of these clients over, and it's a great opportunity for banks like all 3 of ours that are smaller in nature. And people have always said, oh, well, I bank at Wells because there's a bank on every corner. They're a great bank, but I'm not going to throw anybody under a bus, but it seems like, people need to know who their banker is. And that's the most important thing in this environment. And, bank with somebody that you can, when you need to talk to the banker about what you need to do to get your PPP loan, that there is an individual, whether it's Reed or Michael or me, or the bankers that work here, that there is a face, it isn't a 1-800 number. You can sit down and talk about things. Really, really important when you need a bank to know who your banker is, and that it isn't the teller. They can't help you. And so, having branches everywhere is a little different than when you actually need a banker to help you out. We're moving into the phase where these PPP loans are going to be forgiven, and that's going to, be another whole round of some challenges. I think everybody wants to have their loan forgiven. The expectation is 100% of your loan would be forgiven. The reality, now that they've reduced from 75% to 60% the payroll requirement, more of that will probably get forgiven. But there are a lot of companies that still are not back up to full payroll, and there are some rules that are going to need to be followed. And it's going to be our determination, and then we'll submit it to the SBA. We'll work with a calculator at the customer to say you're not going to get 100% forgiven. There may be a lesser amount, and then there'll be probably some sort of grievance process where the customer may think the 100% of the loan should be forgiven, and the calculations indicate that it's 75, and so that's probably going to be a challenge, but we'll work through that.
Hey, Dave, how many rounds do you think are going to be out there for customers moving forward as far as more SBA?
Well,
I know there's always SBA. It's just kind of special stimulus SBA based on, the virus and things. It's, yeah, at some point, I guess they got to pull the plug. I'm just wondering what the window of opportunity is as far as getting help.
Well, this current round, which is the second round of the PPP, expires at the end of this month. You know, there's still money available, but I think as far as the parameters of the program, you know, that 8-week period, you know, I think everybody that has wanted or can apply, actually, there are some people that would like to apply that weren't able to apply. You've got 501c7s that were not allowed to apply. You know, the not-for-profits, several were allowed to apply, but others were not. It's a tough question, Terry. I mean, when is there going to be, you know, some abatement to this whole virus thing? I think that changes behavior significantly. You know, we're seeing some businesses that are doing very well unaffected. You know, general contracting seems to be fine. A lot of people are remodeling their homes. A lot of people are staying home more. There's areas that people are spending more money. There's areas like restaurants and concerts and movie theaters where people aren't spending any money. You know, if you have a drive-through restaurant, you're set up for takeout, you're probably doing pretty well. If you're a sit-down restaurant, not so good.
No, I use the analogy, if you got a strip center and it's anchored by you know, a restaurant that doesn't have a drive-in, and you know, you got a health club where they can't let the people in the front door, and you got, you know, something else that's just having a tough time. You know, it's hard to go in there and say this is an income producing property and I can live off the income coming here when I'm only, you know, maybe getting 50% of the rents I was, you know, 90 days ago.
Right. It definitely has impacted people differently. I mean, you look at the residential home market is still very strong. And, you know, with rates where they are, people want to buy homes. Now, getting a residential loan is a little bit of a challenge. You've got probably 2 or 3 steps where they, you know, want to verify employment. Obviously, employment leads to cash flow. And so, you know, we're seeing that all throughout that process, the residential lenders are verifying employment 2 or 3 times during the process. You know, want to make sure somebody's still got that job that they originally started out with. So,
are you putting up some kind of, maybe some goals? I wouldn't call them stress tests or anything as far as these small businesses, but it seems like, you know, you need to know where they're trying to get to as far as over the next 6 months. You know, if they're going to try to keep their payroll together, if they're going to, you know, they got a product like, you know, there just isn't today, the business model just doesn't make any sense. I mean, a lot of this comes down to how long is it going to take, you know, and that's another tough question, I guess I'm asking you.
I don't think anybody knows how long this is going to take. You know, I think people need to be agile, and a lot of people have looked at the way they were doing business, and, you know, you need to modify it. Certainly, you know, there's always been change, but again, the rate of change is happening very quickly. And, you know, people have had to modify their business to, you know, provide that takeout service, or to, you know, or screen clients before they come into their business, temperature and all kinds of things. So I really think it's, you know, how many people are going to go back to working, want to leave their home and go back to an office? Is demand for office space going to shrink? You know, if it shrinks, what happens to rents? There's a lot of variables in this whole thing, and I think we're all learning as we go.
So just a minute, I guess we're kind of down to our last couple moments here, but I guess the, you know, I want to talk about Tucson a little bit, what kind of shape we're in, just kind of overall. We're not like a Houston, Texas that, you know, is dealing with negative oil prices right now, although it did have a bounce. And, you know, it seems like we're going to benefit from, you know, people leaving LA and riots and Seattle because of their government or debt problems because of Chicago or just sickness because of New York. I would think that we would be a destination location going forward. Are you seeing any of that as far as the nation rolling into our front door?
Yeah, I think we are to a certain extent. People move where either their job moves or, if people can work from home, maybe that'll happen. People will, still work for the firm they did in New York and move to Tucson. That somewhat remains to be seen. We do need to obviously keep funding for our police department. I know that's a topic and one we all need to be very focused on as a business community. This concept that you can defund the police department and we don't need that is somewhat ill-advised. That's probably just my opinion and not necessarily the banks, but we've got a good police department and certainly need to keep them well funded in the city of Tucson.
All right. Tiffany, we got any questions for our panelists before we bid adieu?
Yes, we have 3. All right, the first one is from James Robertson. I'm interested in financing for a restaurant operator to purchase their leased building.
Yeah, we certainly would be interested in talking to them. And, there's several routes they can go. Nobody really likes the 7A program, but if you sprinkle in there that the 7A program for the next 6 months will make your payments, so you end up with no payments for the first 6 months on a 7A program, it really is attractive. So that's an alternative to go with, a smaller, owner-occupied type deal, purchasing their own restaurant, or conventional, depending on, how much money the individual has to put down. And then also, what the cash flow has been. If it's a, drive-through, it's probably been favorably impacted.
All right, next question from Lori Simmons. Are all payments due on the 91st day for the payment deferral, or are your banks tracking on 90 days at the end of each loan term?
I think everybody touched on the fact that it's kind of individually based on the situation. Some of them are tacked on to the end of the loan. Some of them are, picked up in next year in 2021. I don't think we've done any where we put a gun to somebody's head and said, you owe, 4 months of payments in month 91. I don't think anybody did that. Michael, Reed?
No.
No, we're not.
Okay, Tiffany, last question.
Okay, let's see. I guess maybe this is more of a statement. It says, Mike, several of the qualities you have mentioned are exactly why borrowers are having difficulties. Are there any low cash reserves, cash flow, etc.?
Okay, I'm sorry, I didn't hear that last part of the question.
Are there any low cash reserves?
Low cash reserves.
Is that a song?
So basically, the way I interpret it, the beginning of the question is saying that, okay, we want strong borrowers to make a loan. So, and maybe the question needs to be rephrased because my interpretation is that they're saying, okay, that's why borrowers are struggling because they don't have cash. And so is that, am I correct in saying that? Do we have any products that would help somebody that has minimal cash, or what? I didn't quite understand that question. So.
I don't have any more information than that.
That's all right. We can always get back to them and ask them to rephrase and then get a hold of Mike on a after webinar situation and kind of go from there. So anyways, we're right at our 41st minute of our webinar, and appreciate all you panelists that came on today. I know your banks are probably looking towards a stress test. So hopefully you're not. And anyways, we wish you best over the next 6 to 18 months as far as just weathering through this. It seems to me it's not like the S&L crisis back in the 80s, or what we faced back from 2007 to 17 with the toxic mortgages and the lack of liquidity. It just seems like you all are in good shape, making safe and sound lending, going forward and making intelligent decisions with the current situation. So
Yeah.
I'm just glad we're financially, as far as institutions are concerned, we're not looking at a kind of a major fallout as far as the backbone of our country, which is lending and the reserve and just general economy.
Yeah. Hey, Terry, I wanted to touch real fast on the Main Street program, which is another program that's out there. And, clients are asking about it. It isn't a forgivable program. It's a loan. It's at a 300 basis point spread. When I look at the program, the biggest challenge that people are going to have to get it is that you actually have to certify that you're unable to secure adequate credit from other banking institutions. So, in order to qualify for the Main Street lending program, essentially you have to be unbankable. And then that, coupled with the fact that the banks need to keep 5% of that loan, and it is a loan that is expected to be repaid. It's a product that I don't see a lot of banks going forward making those Main Street lending program loans unless, you've already got a situation where you have an airline or you've got a major chain restaurant in the United States that, they're really on the ropes. And the only way that you're going to save them is to hand them one of these loans, and, hopefully they'll be able to make it 2 years and repay you.
Right.
Uh-huh.
But that's kind of a real quick synopsis of the Main Street lending program from my perspective.
Well, if there's interested people on this webinar, please get a hold of Dave as far as, trying to get information and at least a brochure or something on it so they can move forward.
Okay. And the Federal Reserve Bank of Boston website has, a pretty good description and detail on the program itself. Be another way they could go to get some resources.
Very good. Well, thank you, Dave. That's the price of the admission so far, right there, being able to at least have another avenue to walk down if you want to continue doing business. So anyways, thank you all for participating on this. It was, I thought, very beneficial. Hopefully it was beneficial for borrowers and brokers to be able to, come up with some solutions, especially with their clients in a difficult time. So thank you again. And I guess we'll see you next time here with our webinars here with CCIM of Southern Arizona.
All right. Thank you, Terry. Appreciate it.
Thank you, guys.